In my mind, I'm gone to Carolina.
Greetings and welcome back to Fisher Wealth Management's Tips of the Week. I'm Rick Fisher, Managing Partner of Fisher Wealth Management. I will tell you that our inbound call volumes picked up in recent weeks due to stock market volatility. It never ceases to amaze me how many of you want to call and sell when prices are down. Our store continues to be the only one in the world that when things go on sale, people like to get up and leave the store. But remember our previous post. We do believe that we are in the late second or early third inning of economic recovery. And in periods of economic recovery for our nation is typically a favorable period for equity investors. So don't get too excited about near-term pullbacks in our opinion. As a matter of fact, they're very common historically in a bull market. I'll give you a couple examples. In the bull market that we experienced in the mid-2000s area, we didn't go we had 5 to 7% pullbacks, never a 10% pullback. It's been 3 years since we've experienced a pullback of greater than 10% here in the current bull market that we are in. In a typical mid-year cycle, stocks experience 4 5% pullbacks. And this year we've had one, and last year we've had one. So we've been on a real historic rise off the bottom, including dividends. The S&P 500 is up over 200% since their March 2009 lows. Anytime we have a short-term sharp period of decline, I know you do get nervous, but we do remind you to keep your eyes on the prize and don't focus on the funk, so to speak. Make sure you understand what you're investing for. Most of our clients are investing for real long-term things like retirement or educating their children, so you can't get real caught up on what happens on any given day. You really need to look at the underlying economic fundamentals about what's going on. The economy is still improving. GDP is picking up steam. Unemployment is coming down. We've averaged, over 2 million jobs we've added in the last year alone, and the unemployment down is all the way down to 5.9%. The Federal Reserve is already almost completely exited their quantitative easing program where they're buying bonds, and they're not raising rates anytime soon. The European Central Bank is prepared to do stimulus that is necessary to give them the boost that they're looking for. Volatility on the S&P is up a little bit, but China's also indicated that they're willing to add some extra stimulus to their economy as well. So in a period of recovery, when corporate earnings are doing well and GDP is growing, that's not recession period. That's typically a time that's favorable for stock investors. So you got to be really careful to sell into weakness. So don't sell into weakness. Don't get focused on what happens in this market on very short periods of time. Focus on how we do over time and make sure you're making rational decisions based upon the underlying fundamentals of what's going on economically in the world and not just some gut or knee-jerk reaction to short-term price movements in financial markets. If you're not having these types of conversations with your advisor of choice, or you would like a confidential, complimentary second opinion from one of the financial planners here at Fisher Wealth Management, we do welcome you to give us a call. But thanks again for listening, and please stay tuned for more Fisher Wealth Management Tips of the Week.
Ain't it just like a friend of mine to hit me from behind?